So I want to welcome you all here to the Orange County Investment Club. We meet the first Tuesday of every month. We're one of the largest investment clubs out there in the country, second largest only to the New York Club. And uh, looks like they were underwater there this last week. So hopefully the folks out there are doing all right. If you want to find out about who's going to be at our meetings, who's going to be speaking, just check out our website, www.ocinvestmentclub.com. And you can also go to www.ocphoebe.com. We are the Orange County chapter of the Phoebe groups. And Phoebe is an acronym that stands for investors by investors. And that was a gathering that was created by some folks in the LA area that basically wanted to create a gathering where people can get together, um, learn from each other, um, learn some relevant real estate investment information without being sold on a, big crazy, 40, $50,000, program or boot camp. That is not what we are about. We're about bringing experienced investors that are, in the trenches out there that are actually doing deals, and then they volunteer their time and come out here and share with you with the and network with other like-minded individuals, uh, like all you good people. And I want to extend a special welcome out there to any new people. How many, if you would let me know in the chat box, how many of you out there, this is your first time participating with us in one of these gatherings here? All right, we got Bob there. Welcome, Bob. Any others out there? There we go, Jason. All right, Jason, Wendy. First time, Greg and La Habra. Welcome, Greg. We got Sheena out there. Wow, all sorts of people out there. Okay, well, awesome, awesome. All sorts of new people there. Okay, welcome all you guys, guys and gals. And I know that you guys are going to get some great information. So I'm glad you're able to participate with us. Just let me get some things out of the way here. It's not uncommon in these kind of gatherings to have people that may, they may have some business propositions, some business opportunities, proposals, some real estate deals, business ventures, whatever. We do not endorse anybody out there. And when it comes to, tax advice, legal advice, financial advice, um, we always advise everybody to get the consult of a licensed professional. We're not attorneys, we're not CPAs, we're not any of that stuff. We are real estate investors, but as far as legal, taxes, and all that stuff, you need to talk to a professional and do your due diligence on those kind of things. All right, so let me just get some housekeeping things out of the way. So when you guys all jump into the Zoom call, you're all going to be defaulted to a muted microphone. Uh, please keep your microphones muted unless the speakers, ask you to unmute, to ask a question or whatever, because we don't want a whole lot of background noise, messing up the flow of their presentation. Type your questions in the chat box window, please. We got our assistant Zaldi. He's going to be monitoring the chat box, and he'll let us know when a question comes up, and then I'll let the speakers answer the questions there for you. This whole presentation is getting recorded, by the way. Okay. Now, that recording, however, it's going to be downloaded, a little bit of editing, and then it'll be uploaded on a private. It's got a private link on our YouTube channel. Okay. But that private link is only going to be available to all you folks out here who put in the time and the effort, to spend your evening here with us. So if you want a copy of that link, make sure you put your email in the chat box. Our assistant Zaldi, he'll gather the emails, and once we finish with the video, they'll send that link out to you, and then you can watch this presentation as many times as you like. So make sure you put your email in the chat box so you can get the video link to that. And like I mentioned before, We do not endorse anybody's, business opportunities, deals, whatever. Do your own due diligence. If somebody approaches you in that manner, and if you need some help with doing due diligence on something, just ask one of us. You can send a message to us through our meetup site, and then we'll try to help you out there. Networking is encouraged because the rich build networks and the poor sit around home and watch TV. And you folks are getting some good quality information here tonight, because we're going to have David Coe and Bryan Miller from Capital Stack. And they're going to be talking about the ultimate value add strategy, which is development. And they're doing some exciting stuff out here in LA, not too far away from where we are. They're going to talk to you about why development, some basics on development, what they've learned over the years, and how you can get started as well. So, all right. And so now I'd like to go ahead and have some of our sponsors talk about themselves, because they're the ones that help us put these gatherings together. And PropStream is one of our new sponsors. I don't know if Liz is on the call here with us. Not seeing her on here, but PropStream is a very powerful software that allows you to generate leads. Some people use it to find distressed sellers, people that may have liens and pre-foreclosures. But you can also get your comps out there and do property searches. So if you're looking to get into the flipping business, this is a very powerful program. And that special link down below there on the footer, that's a special link for our members. So if you go to that link and you subscribe to the PropStream, you get a special discount on that. So go ahead and check that out. And you can also reach out to Liz down there at the Liz at equimind.com, and you can see her cell phone number there as well. And then Pivotal Capital Group, they are a hard money lender. I believe Matt is here with us. Matt, are you out there?
Yes, sir. How are you doing tonight, Omar?
Hey, Matt. Hey, great to have you. Tell us about Pivotal Capital, please.
Thank you, Omar. For those of you who don't know me, my name is Matt McCarthy. I work with Pivotal Capital Group. We provide funding for fix and flips, bridge loans, new construction, ADUs. Really, we kind of cover the whole gambit on investment properties, even buy and holds. Please give me a ring anytime. One of the new things that we're kind of bringing into the fold is lines of credit for those of you that have a group of folks that buy bulk properties over the year. We can provide now lines of credit to let you guys kind of expand a little bit. So if you have any questions, give me a call anytime. I've put my contact information in the chat. Omar, Jeffrey, Carlos, thank you guys very much. Keep up the good work.
Hey, thank you, Matt. And yeah, that's pretty exciting. If you can get a line of credit, that is very helpful when you're doing these flip properties. So reach out to Matt, Matt M at pivotalcapitalgroup.com. He'll help you out. Matt actually did a flip with us here not too long ago. So we can vouch for him and their team. They're good people over there. And Home Choice Property Management. I don't think Jesse is here with us tonight, but they manage properties here from Long Beach to the Inland Empire. So if you're looking for property management on your rental properties, reach out to those folks. Contact Jesse at homechoicepm.com. And next here we have Trillion Capital, and I believe we have Karen. Karen, you there with us?
I am. Hi, everyone. I'm Karen Moore with Trillion Capital. It's great to be here. Thanks, Omar. It's great to see you and all these familiar faces and lots of new ones too. So that's exciting. And we are a hard money lender. We do fix and flip and bridge and refis and new construction. The thing that sets us apart is that we're just really, we're really client focused. So we do things like we have no fees, which means no junk fees. So we have interest and points, but no junk fees. So that means no document fees, no draw fees, because we come out and do all the draw inspections ourselves. no personal guarantee, and we don't require in-depth financials when you start. So we don't do a credit check. We are truly an asset-based lender. So we base the loan on the project that you put together. Our goal is to build long-term relationships and work with you again and again. And as you can see on our slide here, we have Bruce in San Diego County and Chris in Inland Empire. We've even got someone in the Bay Area. So we only lend in California, but I hope we get to work with you soon. And I did put my information in the chat. I'll put it again. And if anyone needs proof of funds, we can get that to you in just a couple of days. Thanks.
All right. Thank you, Karen. And Trillion, they've also funded a flip of ours in the past, so we can vouch for them as well. They're awesome folks over there as well. So contact Karen at kmoore@trillioncapital.com.
Thanks.
You got it, Karen. And Leon Tax Consultant, there's many different tax people out there, but they're not all built the same. And when you're in the real estate business, you really need a tax person that understands real estate. And Pat Leung over at Leon Tax Consultants, they're fantastic when it comes to real estate related matters. They recently helped us in maneuvering a 1031 exchange. They do pretty much all of our tax returns. So we can vouch for them as well. So reach out to Pat Leung, and they're at www.leungtax.com. And Arbor One Escrow, I don't know if Lucy is here with us. Lucy, are you out there somewhere? I actually heard it last time I heard she got COVID, so maybe she's still recuperating. But and anyways, one of the really cool things that Lucy and her group over at Arbor One Escrow have is that on flip transactions, they do not charge fees when you sell the property, which is something really unique. I don't know of any other escrow companies that do that. That is very, very investor friendly. And as real estate investors, you really need to work with companies that understand investors. Sometimes as investors, we have to do some creative, financing type things, and sometimes do stuff that's a little out of the box. And not every escrow company is able to handle some of those things. So you really want to work with an escrow company that's geared for investors. So reach out to Lucy there, Lucy at arbor1escrow.com, and they'll help you out like they've helped us out. Okay, so those are our sponsors, and they are a valuable resource for all of our members. They're great for helpful advice and guidance, especially the hard money lenders. If you're looking to get into the flipping business and flip some houses out there, if you got a deal you're not too, maybe not too certain about, run it by, both of the hard money lenders, because if they're telling you this deal looks good, then, or they're willing to fund it, then you may have something there. Okay, so definitely reach out to the sponsors and let them know that you heard about them here. Okay, in our next event next month, we're going to have our sponsor there, Pat Leung over at the Leon Tax Consulting. She's going to be talking here about tax planning for your real estate assets. And we're also going to have a new speaker here, Alex Varela. Alex, she helped me out and my family not too long ago set up a living trust here for my mom. And she's going to talk to us about estate planning and how to avoid probate. Probate is a very expensive proposition, and something that is avoidable, and you should definitely avoid that at all costs, because if someone in your family does pass away, you don't want the government getting involved in there and chipping away at the at the inheritance for all the other heirs. So join us next month. That's going to be on October 5th, and that's going to be another good one there. Okay, so this I was mentioning earlier, our YouTube channel. This is the channel where the video of this whole presentation is going to be uploaded. And for any of you that are just joining us, this whole presentation that David and Bryan are going to be speaking at here, the whole thing's going to be recorded. It's going to be uploaded to YouTube, but it's going to be on a private link, a private YouTube link that's only being made available to all you good folks here who joined us here tonight because you put in the time and the effort to be here and get this information. That link will be available to you. To get that link emailed to you, you need to put your email in the chat box. So go ahead and put your email in the chat box. Our assistant Zaldi, he's going to gather those, and then he'll send you the video link for the video there, and then you can watch this presentation as many times as you'd like, and make sure you don't miss a thing. And then, of course, like everyone else, we got our Facebook page. You'll see some cool stuff on there. Some of these videos, some video snippets, and some interesting stuff that's going out there in the real estate market. So give us a like on Facebook, share us with your friends. And okay, and without further delay, I'd like to go ahead and present to you folks here David Coe and Bryan Miller from Capital Stack Investments. They're going to be talking to all of us about development, the ultimate value add strategy. And David and Bryan, the floor is yours. Thank you for joining us.
Awesome. Thank you, Omar. Bryan, how's your audio? You good?
I am good. It's really nice to be here, guys. And even if you're not into development, we're going to talk about a lot of things that are across the board that are going to be helpful for your investing career, whether you're doing fix and flips or buy and holds. A lot of the same principles work across the board. So we're looking forward to a great night with you guys.
Absolutely. So I'm going to go ahead and share my screen here. Let me see. I hope that is coming through for everyone. Bryan, it looks good?
Looks good.
Okay, cool. All right. Well, hey, again, we're really happy to be here. You know, Bryan and I have both been, we've been friends and investing together for years on different things. And I'd say about the last 4 or 5 years, we've gotten more into development. And you know, the title of our presentation here is called The Ultimate Value Add Strategy. And that's why, you know, we believe in LA, we believe in California, and it's hard to find a deal in California unless you build it. And that's really what we're going to talk about today, is how, you know, we're finding value through development here in Southern California. So Bryan and I are going to kind of both run through this presentation together, just to give you an idea of who we are. You know, Capital Stack Investments, we are a real estate private equity firm, and our specialty is Southern California development. And what that means is that, you know, we aren't necessarily builders. Don't let the hard hat on the pictures here fool you. You know, while I guess the fancy shirts probably would have been a clue, right, Bryan, that we weren't actually doing the construction. So what we like to do is the financial part of development. You know, we'll partner with different builders, different contractors, people that have projects, and then we'll bring in our expertise, which happens to be in creating syndications, pulling together, raising capital for different kinds of investment projects. And as Bryan mentioned before, he and I have been involved in all kinds of deals in our investing careers. In fact, if you go to our website here, capitalstackinvestments.com, we actually have something on our website called Lessons from 50 Deals. And if you're interested in just getting exposure to different lessons that we've learned, go to the website, go ahead and put your contact information in there, you know, and then, you know, every couple of weeks, you'll get one of the lessons that we've learned from the 50 different deals that we've done, which are more than development. I mean, Bryan, what kind of stuff's in there? We've got fix and flip. We've got, what else we have in there?
Yeah, buy and hold, the advantage of, you know, when you look back 10 years at a break-even deal and you realize you made 100 grand, you're like, that was a pretty good break-even deal. So there's a lot of insight, and it's just amazing. Like, over the course of time, some of these lessons were really expensive to learn. So you get the advantage of just reading them and not necessarily paying the admission price for the learning that lesson. But our goal is to share a lot of information with you, stuff that will be very valuable to you, how to vet deals, things that we've found along the way, how to vet partners, how to look for different red flags. And then also how to look for the green lights, right? How do you look for deals that is going to make sense, or how do you vet partners where there's information there, how we've learned to really successfully vet partners so that we find really great deals to get involved with.
David, Bryan, sorry to interrupt, but I just want to make sure everybody is aware that if you guys have any questions for David and Bryan, all of you listening here, please type in your questions in the chat box, okay? And our assistant Zaldi, he's going to be monitoring that. And then as they go through their presentations, we'll let David and Bryan know that questions come up. So thanks, guys.
Yeah, you got it, Omar. And I've got the chat box open here, but I've also got like 14 things happening on my screen. So we'll try to get to questions as best we can here. But don't save your questions for the end. If you have a question, put it up here. Feel free to ask it. If it's something that we're going to cover later on in the presentation, we'll let you know that. But feel free to add your questions in here. And like Omar mentioned, he talked about Phoebe. I am also a Phoebe chapter leader. I run the South Bay chapter of Phoebe, as well as I'm part of the board that kind of guides Phoebe as a whole. Phoebe is a not-for-profit. We do not make any money off of Phoebe, and we purely put together this community of like-minded investors because we understand how important it is to network. And Omar, by the way, I love that quote about successful people build networks, poor people watch them. I've never seen that one before. I'm so going to steal that. And it's so true. Real estate is not a property business. It's a people business. And I think that's a lot of what, as we go through this presentation today, and just as we go through our careers as investors, the quality of people that you meet along the way will directly impact the quality of investor you become. So, glad everyone's here. I hope you get a lot of information from tonight. And one other thing that, I wanted to talk about here is, Phoebe got involved 4 years ago in a conference called the Intelligent Investors Real Estate Conference. The first two were here in LA. The third one was on Zoom last year. But if you like Phoebe and the concept of Phoebe, this is Phoebe on steroids. Now, it's a little more expensive. This is a 3-day conference, so the tickets are a little more expensive, but this is high end, next level kind of thinking. We have some incredible speakers that we're pulling together, and we, as of right now, our plan is to be in person January the 20th through the 22nd in Manhattan Beach, California. I've got the link is there for the IIREC page. So if you're interested in that, there's that link. And so anyway, that's kind of who we are. And Bryan, anything to add to that?
Well, I just want to make sure that everybody knows what an incredible resource the Intelligent Investor Real Estate Conference is. This will be number 4 coming up. I've been to all of them. I go to a number of conferences, and this is by hands down one of the best. Again, is talking about the network, people that you're meeting there. You're dealing, especially if you're a accredited investor, if you're dealing with syndications, if your problem is I have 100 grand and I don't know where I should successfully deploy that, it's a great room to be in because you got a lot of other people with that same problem who are looking for that solution. And the great thing that I found by interfacing with those guys is, a lot of them had learned lessons, right? Like we learned, right? Who to invest with, who not to invest with. And it can save you years and literally hundreds of thousands of dollars by choosing winners and learning how to figure out who is the winner. And also, sometimes you don't know when you're going into an investment, like every investment looks really good on paper, right? I've never seen a pro forma that's all 4-color, great numbers, great returns. You can't tell from the slick glossy brochure, right? Everybody has that. But if you talk to a guy who's been investing in something for 5 years or 7 years, they've had 3 deals go full cycle, that's a whole different level of due diligence than trying to find all the misprints in the slick brochure. So going to these conferences is a great way, and this is a great conference. So I want to invite each of you to come join us. If you're into golf, we're actually Capital Stack is involved with a golf day, I think on Thursday. So come have some fun, but most of all, you're going to meet a lot of like high level, high caliber investors. People don't show up that are I mean, typically it's not a first-time investor kind of thing. It's people that are either full-time investors, very serious about it, trying to go for financial independence, a great room to network in. So just want to make sure you realize what a great resource that is.
All right, well, let's jump into it. Okay, so for tonight, our presentation is divided up into 5 pieces here. So the first part is the case for California and Los Angeles. And listen, I know everyone has been bagging on California and LA. And I'm here to, I'm gonna make the case today that, you know, regardless of what you're hearing and regardless of the stats that you're seeing from U-Haul, of all the mass exodus outside of California, that the California market is still one of the strongest economies in the world. And, you know, we believe it offers a lot of opportunity for investors. Bryan's gonna take you through why development, right? What are the reasons why we're involved in development? I'm then going to kind of take you through some development 101, like what are the phases of development, just to give you an idea of what's involved in building something. You know, as we mentioned, we've learned a lot of lessons and we've tried to distill as much as we've learned into some of these lessons. They apply to development, but I think they apply to investing in general. So hopefully you'll find some useful knowledge out of that. And then lastly, how you can get started. So if you're interested in being exposed to development, investing in development, there's different ways you can get involved, and we'll kind of walk you through some of those ideas. So first things first, let's go through the case for LA, right? Now listen, again, we've all heard it, right? Everyone's bailing from California. You know, the mass exodus is upon us, but there's a lot of things that California has going for it. Number one, you know, obviously we have one of the strongest economies in the world, in the history of mankind. And I'm going to talk about that. We're going to talk about the idea of migration versus immigration. We're going to talk about jobs, job growth in particular. We're also going to talk about what's kind of driving this current surge in real estate, right? And a lot of that is generationally based, especially with millennials and the Gen Y. You know, people that are entering into their, you know, house buying phase of their lives. And lastly, we are going to talk about supply, the California housing supply. All right, so some of this stuff may be information you've seen before, but in case you haven't, you know, California as a whole is the 5th largest economy in the world, right? So let alone the fact that, you know, the United States is, you know, by far the leading, by a GDP standpoint, the largest economy in the world. California itself is larger than India, the UK, France, Italy, and Brazil. You know, it's just an incredible state, a lot of natural resources, and, you know, there's no sign of that economy starting to slow down. And then when you look at the Los Angeles area, LA actually has the 3rd largest by GDP economies in the world. So as far as cities are concerned, right? So just behind Tokyo and behind New York, there's LA. And, you know, and some of this information, you know, the latest stuff we have was from 2018, but the metro area for LA generated, you know, over $1.3 trillion in GDP, you know, as in 2018. And when we look at the growth of where Southern California is projected to go, we are projected to add 246,000 jobs in 2021. So this is a stat that was done, you know, during COVID, right? This isn't a pre-COVID stat. This is a post-COVID stat. And I thought this was interesting. The Southern California job market is projected to add more jobs than Phoenix, Houston, Austin, Denver, and Charlotte combined. Right? LA is just a mammoth area that has such a diverse economy. And that's one of the reasons why, you know, LA continues to attract people, but there's certainly, it's not for everyone. The 5 markets that I just mentioned above, by the way, they're projected to combine for 227,000 new jobs. And yes, there are people leaving California, right? So when you look at the migration out of, you know, out of the state, California has one of the highest levels of migration out to other states. But it also has the third most in migration back into California as well. So yes, there are a lot of people that are leaving, but there are also a lot of people that are coming to California because of the strength of our economy. This is a look at LA County growth rate. And when you look at where we've been over the last, 7 years, we have been losing some people in LA County, about 1/3% for the last 4 or 5 years. But LA County still has almost, 10 million people inside of it. And the amount of people that are leaving is pretty small compared to the actual size of our population. I also think it's one of the things that people talk about. They always look at migration outside of California going to other states. But what's equally important is you have to look at the net migration from other countries, right? So, when you look at the history of California, this is the blue line. Over the years, California has had periods of time where people were moving into California. Then in the 90s, they were moving out of California. Back in the 2000s, they were moving into California. Then they were moving out in the late 2000s, kind of got back to even in the 2010s. And now people are leaving. But what happens is when you look at net migration from other countries, that's always been positive. And the reason why is because of the diversity of our jobs. We produce some very highly technical jobs that attract people from the Middle East, from Asia, from Russia, from Europe. A lot of high professional people end up being in California just based on the strength of our economy. And that's one of the things that, for every person that we are losing maybe to moving to other states, we're gaining people from other countries that are coming to California.
Dave, is it okay to chime in with the question?
Yes, please.
Okay, there's actually a couple of them came in. Jack was asking if, and I think you may have addressed this already, if you and Bryan are also construction developers.
Yeah, we are, well, I guess we are developers. We're not contractors, right? So that's the difference, is that, we don't have contractor licenses. We're not in charge of the day-to-day construction of projects. So you can't hire us to come build your house or add an ADU to your property. But we are developers in the sense that, on more of the financial side of developing, helping to raise the capital, structure deals. Every property has multiple ways of, how you structure it. How do you, what kind of returns are you looking to promise? What's the split with investors? What kind of debt are you looking to take in? How much debt are you looking to take in? And that's really where Bryan and I get involved. It's more on the structural side of putting a deal together. And then as we also get really involved in, kind of being another set of eyes and ears and brains and problem solvers. New construction is constantly problem solving. It is the most advanced, technical, complicated real estate investing you can do. And you're constantly solving problems. And that's really where we get involved in it. It's more of helping to structure the deal and then, being problem solvers along the way.
That's great. I love that, the problem solver aspect of it. And Charles is asking, what are some ways you guys source deals?
Multiple ways. Ideally, we love projects that are already entitled. And what that means is that, we would prefer to take a project that already has all of their permits approved by the city or whatever the governing body is that is going to be authorizing that. So sometimes we'll work directly with developers. They may have a project and are just looking for some help in getting it funded. Sometimes we may find a project and take it to a developer. I am also a licensed realtor. I run a Keller Williams team here in the South Bay. So we just come across all kinds of opportunities. But most of the stuff that we're developing, generally, we're finding developers that have projects that are just looking for some help in getting them out of the ground. Bryan, would you say that's pretty accurate?
Yes, and a couple of things just to bring you up to speed if you guys are ever considering jumping into this. Um, Sometimes construction has a reputation like that's so risky, right? And so it really depends on when you're jumping into that scenario. And so if you're jumping into a pre-entitled piece of dirt, right? And that basically you don't have a right to build anything on that piece of dirt. And you're going to buy that piece of dirt. And if it's going to be expensive and you're going to carry debt on that, you basically have a very long runway till you can get any kind of money, right? So you have to be very careful when you're pre-entitled, when you're not entitled. You basically have a piece of dirt, and the city, you don't have the right to basically do anything on it. We tend to like and favor projects that are by right. So that gives you the right to actually go build 4 units or 6 units or 4 units plus an ADU. When you have that by right, you have the legal right to go do that. There's still some hoops you have to jump through, but that's a much different scenario than if you're just taking a piece of dirt and you're like, hey, this would be great to have a 28 unit apartment building on here. But if you don't have the right to do that, you're talking about probably a 3-year window, maybe longer.
What happened?
And so in that, you have to make sure you have enough runway and you have enough deep pockets to get through that project. So in that, you just again have to assess the risk and your partner. But also that's part of due diligence, is really figuring out where that project is really at, not where the developer says it's at, but where it's actually at, in order to assess the risk. And that's why we like to be involved with projects that are already fully entitled. We can go start building them day one, and we're much closer to the end result than if you just were starting with a raw piece of dirt.
It's very interesting. So somebody will come by, and then they'll already kind of have some of that the entitlement portion of it, and then that gets you guys ready to hit the road and get things moving along.
Yeah, and also reduces quite a bit of risk off the project, knowing that you are RTI, which is ready to issue. That's a much safer position to be in than a pre-entitled, and you don't know. That could be a 2-year, 3-year window, or you could come back with a big no that you can't build what you want to build. Then you're back to square one at the end of 2 or 3 years.
Oh my God. Okay. Wow. Very cool stuff. One more question, because I think the floodgates are starting to open here.
Yeah.
Okay, Michelle was asking. Okay, she's referring to one of your slides. Really great information on these charts here. Michelle Hunter was asking what kind of jobs. Probably on I'm assuming the job growth slide.
Yeah, we're actually getting ready to jump into that. And then let me also, Julio also asked a question about, do we develop residential or commercial? Well, technically it's residential, but they're actually commercial projects, right? So if you build a house, that's a residential project. If you build 37 houses, that's a commercial project. So we are technically building commercial, but we only like building homes. And again, part of the reasons why we're going through the slide here is, developing commercial, we don't see it as being an inherent need of society, but we do see it as being residences, places to live, which we're about to get into here. I think part of what we're going to talk about here is the fact that California is woefully undersupplied from a housing standpoint, which is causing a lot of the problems that we all hear and read about in the news. So let me keep going through here, because this is really, I think, a lot of information about the job growth, and I think some people already asking some questions about the fact that migration is something that you have to look at by wealth levels, right? And this particular chart, everything that you see here that is the kind of the yellow and the green are less wealthy people, right? Versus everything that's kind of the maroon, the purple, and the blue are people that are more wealthy. And when you look at that and you look at net migration, California has been losing more and more people that are blue collar people over the last decade. But we've been gaining more people that are, more white collar and have more professional, higher educated kind of jobs. And that's just the kind of a byproduct of the nature of our economy. California attracts educated people, right? When you look at migration, again, everything on those first few bars, are migration, less migration, net migration out of California. And that includes, people that have no high school degree, they're only graduates from high school, some college, or maybe a 2-year degree. But when you look at bachelor or graduate degrees and you look at the amount of people coming into California, you'll see that that's actually very positive, right? So smarter people, more educated people are coming to California. Less educated people are leaving California because it is expensive. And if you're making a $1 per hour wage in a job, it's hard to live here. California is a net importer of highly skilled professionals, right? So think about our economy, right? Professional and technical service, information services, a lot of startup companies, arts and entertainment industries, right? We have a huge entertainment industry here, aerospace, right? Some highly technical types of careers that are here. And we tend to attract those kinds of individuals from highly compensated occupations, right? So architects, engineers, mathematicians, computer scientists, doctors, lawyers, scientists, people that have, advanced degrees and are highly paid individuals. There's a good chance that if you work in some of those industries, at some point in your career, you're going to end up in California just because there are jobs here, right? And if you're looking for opportunity and you're looking to grow, a lot of those jobs throughout the country exist, here in California. At the same time, we are seeing an exodus of those in blue collar jobs, right? So, people in the accommodation space, especially during COVID, construction, it's been one of the biggest challenges we've been having, during COVID has been, getting people on the job site. Either they've left town or they're on unemployment and they're not actively looking for work right now. Manufacturing jobs, retail and trade industries, these kinds of blue collar jobs are leaving California. And the negative migration out of California that you hear about, it is coming from some of these jobs, maintenance jobs, groundskeeping, food prep, food service jobs, sales, transportation. These kinds of jobs are jobs that people are going to other less expensive communities and they are leaving California. Although I've been seeing some stats when you really look at what's happening in real estate in Phoenix and Denver and Boise and Austin and all the places that people were looking to escape, all of a sudden those places, they aren't as cheap as they used to be anymore because so many people have migrated into those states. So I think what we're also starting to see is some people that are moving back to California because either A, they couldn't find a job that allowed them to live the kind of lifestyle they thought they could live in these less expensive markets. And they're coming back because, they're just getting better jobs out here in California. The next thing we're going to talk about is, kind of the latest surge in real estate prices that we've been seeing. What's been driving that, right? So if everyone was leaving California, you would assume that our real estate market would be crashing right now. It's not. And the reason why is because a lot of people that are leaving aren't necessarily high-end homeowners, right? A lot of them are renters, blue collar kind of people that are leaving. And a big part of what's driving our current boom right now is the fact that millennials, which on the slide here are the 72.12 million people. It's the largest generation in the history of mankind, bigger than the baby boomers. They're all turning 30, they're all getting married, and they're all getting ready to start a family, and they want to buy a house. And it just so happens in this, in this time of their lives, interest rates are as low as they've ever been, historically low. I got an email today from a lender who is looking to refinance sub 2% on a 30-year fixed. So crazy, crazy low rates out there. What's happened is that there's this huge demand that's been building. And unlike 2005, 2006, where a lot of that demand was artificial demand, right? It was banks were creating demand by giving bad loans, loans overvalue. There was a lot of things happening with appraisals, and properties were appraising that never should appraise, and properties were artificially being raised. And then of course we had the huge crash in 2008, 2009. But the boom we've been having right now has been based on more solid economic principles and fundamentals. We've got a huge amount of demand, a lot of people that are looking to buy, and we've got a restrained amount of supply. Now, part of that in California is just based on the fact that we're underbuilding in California. And we'll talk about that here in a minute. Part of it has been because of COVID, right? Because of COVID, there's been a lot of people, older people that should be looking to retire and downsize, that just didn't want to have a bunch of people running through their house with the virus hanging out there. So they've been holding on to their property and waiting for the right time to sell. And it's been driving prices up. But the millennials here, and then right behind them, Gen Z, who will then be coming into their prime, buying cycle, like in another 7 years. There's a lot of demand that's coming for housing, and there's a good chance a lot of these people that are younger, educated, with good jobs are going to be looking to buy, places here in California. Another way of looking at net migration, besides looking at it by income, is looking at it by age. And this is a chart that tracks migration both in Orange County, which is the red, and LA County, which is the blue. And as you might expect, when you see people in their, kind of their, mid 20s through their mid, almost to late 30s, the actual net migration into California here, and this is specifically LA County and Orange County, are positive. But as people get older, right, that is where you start seeing a net migration out of California. Except for some reason, people that are 75 plus seem to love Orange County, right? There's a spike there at the end of the chart. I guess they're buying up in Coto de Casa and all those other fun places that old people buy in. No offense, Brian, who just moved down to South Orange County. So this is just a look at some more kind of generational information. In 20, this is actually 2020. We haven't seen the stats yet for 2021. 38% of all homes that were bought by either millennials or the young Gen Y group. So, almost 40% of all homes are being bought by people under the age of 35, which I think is interesting. I think for a long time, people gave millennials the rap that they're never going to own anything. They're going to Airbnb and Uber their way through life. And it's just not true. They are consuming real estate at a huge pace. And one of the projects that Bryan and I are involved in right now is a small lot subdivision up in North Hollywood. Price points are, in the kind of mid 7s to mid 9s for that kind of house. Perfect for first-time home buyers. And of the 27 houses that we've sold, 0 houses right now are being bought by someone over the age of 40. So, they're taller, they're skinnier, they're stacked. There's a lot of stairs, so that also drives it. But these are younger people that are just ravenous in their consumption of real estate right now. And then again, we talked about mortgage rates. There are historically low interest rates, like not just low, 10-year low, like, low in the last few, no. This is like all-time low rates right now, sub 3%. And, it's just a good time to be getting long-term debt. And that's on, a house that you live in. It's on a rental property that you want to hold for a long time. Right now, loans are almost as attractive as real estate. So anything that you can go get leveraged up right now, it now is the time to lock that in. And I don't think there's any expiration on that. And, all the projections that I've been seeing still show rates being fairly low here for the next, 12 to 18 months. So, it's a great time to be, putting long-term debt on real estate. All right, so let's talk about the last section I have here is specifically on California. We have 3 we have three housing problems. Okay, number one is homelessness, right? We have over 150,000 people sleeping in shelters or on the streets, and a lot of that's in the major metros. So looking at Los Angeles, looking at San Francisco, there's definitely an issue with homelessness here in our state. Number two, rents are expensive, especially when you look at it relative to our general population. 7.1 million people of the 39 million people in California live in poverty when housing costs are considered. That's a crazy stat. And the last one is that, homes are expensive, right? In the 1960s here in California, homes cost 3 times on average of your household income. That's now 7 times. And part of that, I think, is a kind of an indication on where prices have gone in California. I think part of that is just an indication on wages in general, right? I think, over the last 20 years, wages haven't, have kind of stayed relatively flat and haven't kept up with the price of real estate. But all of these problems have one main root problem. There's just not enough housing in California. And the reason why, we rank 49th in per capita housing supply. It's hard to build in California. There's not a lot of land, in California. And in fact, most of the stuff that Bryan and I are involved in, we're not buying land that's never been developed and putting something on top of it. We're doing what's called infill construction projects. So we're taking older stock and raising it and putting brand new property there. And those kinds of projects, they don't really appeal to the big builders, right? Big builders love buying huge chunks of property, building hundreds of houses at a time. And unless you get way outside of the downtown urban core areas, there's just not a lot of land like that left here in California. Some of the other reasons why is the cost of construction in California is way higher than other parts of the country. Part of that is due to the time it takes. We've already kind of touched lightly on the idea of the entitlement phase and some of the things that are involved with that. We're going to touch on that here a little bit later. But part of it's just the fact that labor is more expensive, land's more expensive. Even buying, supplies, buying, the material cost of building can be more expensive here in California than other parts of the country. And a lot of that's due to our tight environmental regulations, right? And there's a lot of red tape, getting permits, having to get approval by your neighbors, going through CEQA. There's all these different regulatory bodies. And if you build anywhere near the ocean, you have to go through the Coastal Commission. There's just a lot of different hurdles that you have to clear to build something here. And we don't see that changing anytime soon, right? No matter what's going to happen, in the next couple of weeks with our recall or whatever your political beliefs are, the system in which we have that builds to build houses here in California is going to take years to improve. So building here is difficult to do, which is why there isn't more of it.
David, do you mind if I chime in with a quick question on your last slide there? Just kind of
Sure.
get questions going on here. Interesting what you were saying there about the cost of construction, supplies going up. And I always kind of hit a little bit on a previous flip, and with the cost of wood going up, and now it's kind of settled down. There's some people that think that's inflation related. I think it's more supply related. Do you have any opinion on, as far as cost of supplies, what they'll trend in the future here?
Yeah, they are starting to go back down. Wood in particular is one that is, finally, now it's still higher than it was 18 months ago, but, the real high peaks that we had 3 or 4 months ago, those prices have started to kind of settle a little bit. The things that we're dealing with now, I wouldn't say so much it's pricing. I would say it's the availability of things, right? I mean, we've all been hearing stories about computer chips. The car industry is decimated right now because they can't get computer chips for cars. Well, computer chips are in houses as well. They're in appliances, they're in smart home systems, a lot of stuff that we're building for millennials. So we're building smart homes. Those types of things are hard. But, even things like electric panels and, for some reason, there has been a run on plumbing supplies. So PVC piping and copper piping, stuff like that it's not just that it's gotten more expensive, it's just that it's gotten more scarce. And you know, there's some stuff. I mean, Bryan and I were on a construction call this morning. I think, Bryan, what was the estimate on when some appliances are going to be done? Was the estimate? We don't know.
We don't exactly.
Yeah.
So
Yeah.
it's really easy to plan with that kind of precision.
No, that's very interesting insights. I know on some of our apartments, yeah, getting a refrigerator or stove was going to take months, and you know, so our managers, you know, they just had to create creative and start buying, you know, some used stuff out there. So
Yeah, and Omar, like, hey, buying, you know, trying to find a refrigerator is hard. Trying to find 37 refrigerators, right? Like that's where we get into even, you know, bigger issues, because especially because we're mass producing, you know, so it's like, look, when someone sees the model, that's what they want, right? So we're kind of locked in sometimes to you know, to what we need to do. You know, we got delayed almost a month on phase one of one of the projects because we just couldn't find electric panels. The panel, literally the panel that you put, that everything gets hooked up to, were on back order. And it took, it felt like we were tracking it on the train on its way out here, because we had to buy, 27 of these things and all the appropriate fuses that go with it. So those have been the types of things that we've been dealing with during COVID. And I'd say really in the last year, it's been less the price of materials, it's been the supply of materials that we've really been up against the wall with.
oh, okay, very good. Thank you for that.
Yeah. All right. Let me keep going here. So, where are things going? Well, when you look at the projections in California, people have estimated that in California by 2050, right? So we're talking about 30 years from now, it's going to be almost 50 million people. We're currently at 39 million. So there's anywhere from 11 to 13 million that we've seen of people that are going to be added to California here in the next 20 years. And nearly 40% of them are going to live in SoCal, right? So everything from, Santa Barbara down to the Mexico border, that's where a majority of these people are moving to. And that surge in population, it's going to fuel, a need for, 68,000 new homes every single year to meet that kind of demand. And chances are we won't be able to meet it because we haven't been. And because of that, we're still going to be in this undersupplied market for the foreseeable future. And as long as demand keeps up, which again, we're projecting it will, just because of the natural demographics of society and people that are entering their home buying phase of life, we still see home prices staying strong, at least in the immediate future here in California and especially in Los Angeles. So that's kind of the overview on why California and Los Angeles in particular. Before we move on to the next section here on development, any other questions just kind of on the, the economic side of California and LA?
Everybody, if you got any questions, please go ahead and type them in the chat box. This is a great opportunity. You guys all have to pick the brains of two very experienced construction developers, real estate investors. So, please take the opportunity while you have it.
Cool. All right. Well, we're going to keep charging on. If you have them, just keep throwing them into the chat. And Bryan, I'm going to turn the mic over to you here.
Perfect. So after that very in-depth and educational thing, you go, why would anyone want to do that? Why would you want to do development? Well, there's a reason we're all on the call here, and that is because as investors, we want return. And we want the highest return with the risk-adjusted amount of risk that's appropriate. But we basically want return, right? So we go, how do we get that return? So there's a couple ways. Right now, if you buy a stabilized asset, like in Long Beach or Hollywood, right? So properties are selling 4 caps, sometimes sub 4 caps, right? I'll talk just a little bit more about that in a second, but basically, that's basically the price someone's willing to pay for the income stream that property is kicking off. So if you go buy a stabilized asset, let's just say an apartment building, it's rented, the rents are basically about what the rent should be, you go buy that. I've seen a lot of deals like offering 4% annualized return to investor. Now you'll still do pretty well over the course of 10 years because you're going to have appreciation, you're going to have debt pay down, all these benefits of owning real estate. But 4% return, it's hard for a guy like me to get super excited about that because I like juicier returns. My goal personally is to grow my capital stack, right? I want a big enough stack that I can then turn into my 8%, 10% return on something a little more consistent and conservative. But if you make 8% on $200,000, it's not going to change your life, and you're not going to be able to live on that. So we're basically wanting to move up in the kind of this risk reward basis in order to produce great returns for ourselves. So the second thing on this list is the value add investing. So maybe the rents are a little undervalued. Maybe there's some opportunity to add another unit, but basically value add. But you'll see these kind of deals across America. Hey, the kitchens haven't been updated for 15 years. We got some ugly carpet. The kitchens look like they got some really nice oak cabinets that have been bid up. So the idea is to buy that, update it, fix it up, able to raise rents, and you'll do value add investing. And so typically a range for that is 9 to 13%. If you want to jump into the fix and flip market, again, there's a large variety here, but if you're basically taking something that's not worth very much money, making it super nice, then you're going to get a higher rate of return for that. And it's a little bit, we call that moderate complexity because, it's not as easy as just, hey, let's go buy 10 units that are rented and you just take over and you're just making market rents. That's basically very simple, but you're going to get the low return. When you get into the fix and flip things, again, you're solving problems. You're going to get compensated if you choose well and you pick good projects and you solve those problems in a timely manner. So the next thing that's highlighted in red, that's where Dave and I really like to be. It's buying projects that are by right, which means you have the right to build those, or they're already fully entitled. So somebody's already been through that entitlement project. We're either buying it entitled, or maybe that developer has on their own gone through that entitlement process and then is now looking to basically raise some more capital to take it through the building phase. That shortens the time frame that we're involved with projects, but it also reduces the risk. It's still very complex, but now you can start getting into the 20-25% return. So when you look at 25 or 24 compared to 4, that's like a 7x kind of return, right? That's 7 times the return. Now, yes, more complexity, but definitely more return, and you're getting compensated for taking that complexity on. And then the final level is the entitlement or land development. That's somebody taking raw land. The people that would be the best with that would be like a D.R. Horton, your big Toll Brothers. They're basically taking big chunks of land, building streets, putting sewers in, doing infrastructure. The reason that works is because they're highly sophisticated organizations, usually taking on highly sophisticated investors, right, and Wall Street money to build these major projects. You don't want to take on entitlement risk and land development with I would say a relatively new operator, a relatively new developer, people that haven't been through this process. This is very difficult. And I would say, when people say, oh, construction, that's super risky, it's because there have been people that have been in this last bucket. They've gotten into projects and they haven't understand how complex it is, or maybe they weren't disclosed how complex it is. I met a guy a long time ago. They bought land it was on the Strip in Vegas. Well, it was close to the Strip in terms of proximity, but it was way away from the main Strip, right? And now you got a piece of dirt in Vegas, right? And until you get a right to build a hotel on that, you have a piece of dirt in Vegas, right? You don't have water, you don't have sewer, it's very complex, right? So you want to look at that. And if you do it well, you can make a lot of money in that business, right? People that really entitle land, but it is by far the most complex.
And I think it also has the most unforeseen delays and complications, i.e. neighbors, right? NIMBY mentality kills so many deals. People that don't want development in their neighborhood, and don't ever underestimate the power of motivated people to kill an entitlement.
Sure. I mean, you could find some bones and you find out it's an Indian burial ground and nobody wants to disturb it. There could be a lot of things. And if your capital is tied up in that project, you're going to be tied up in court a long time until you can do something. So again, if you jump in when it's fully entitled, you basically have the right to build. There are still risks. You have what I call completion risk. You're still going to need to be able to complete your building and get it built, which is not simple, but it's much easier to manage that than a lot of unknowns as far as like who's buried under the ground that you might, when you start excavating, or what other kind of environmental groups are going to come out of the closet and make your life very interesting and difficult.
Brian, David, somebody just chimed in with the question here. Greg is asking, could a major change in regulations from the state government change the high cost of construction and homes? I guess.
I would say absolutely yes. You see the opposite, like in Texas, people talk about building these major projects and there may be 2 months or 6 months through that development project rather than, or that development period and that approval process, where in California it may take 3 years, 4 years. So how many people want to take on a 3-year or 4-year risk versus like a 3-month or 4-month risk? If you made it simpler, I mean, California, one step in the right direction was the ADU laws. It is going to provide more supply. There's some complexity with that. There's some downside to that, but it is providing more supply. That will be a good thing for housing. Is that enough to solve the problem? Absolutely not. Is all the red tape and the government interference? I heard Grant Cardone. He's like, I love these restrictive states who make it really hard to build. He's like, I love investing there because it makes it difficult for anyone else to develop there, right? You limit supply. It's supply and demand, right? Very old kind of simple concept. But if you limit supply, which the government does, and in some cases, from a perspective of trying to be good or help people or protect neighborhoods, but you limit supply and you don't allow the market to do what the market wants to do, then you're gonna see high prices. So if it was easier, yeah. But again, these are highly complex issues. If you just make it easy to build anything you want, you're gonna have also other problems. And people don't want like a 200 unit apartment building in San Marino, right? It's like those people pay a lot of money for their beautiful neighborhood and they want to keep it that way. So these are complex, but yes, regulation, times that it takes to get things built, to get them approved, to get inspectors out, it does contribute to the cost for sure.
No, that's very helpful there. And Chris Liu was asking, this is kind of an interesting question. Have you guys built or tried to build prefab modular homes? What's your perspective on that?
We've actually, one project, we haven't done any prefab yet. We have done some containers, ADU containers. So one of our developers right now is actually building, adding ADUs through that, basically converting old containers into ADUs. But I haven't done an actual prefab. I know a lot of that type of inventory is out there yet. We just haven't gotten involved in it. A lot of stuff that we do is a little more, would you say, Brian, a little more complex and stuff that, needs a little more steel and wood than I think you could get with a prefab.
And prefab sounds really easy. Hey, we're just going to build it offsite and just drop it here. But again, we're still very early into that model. It's promising, but I don't think it's simple yet. And I think it has promise that if you could really do that, even some of the ADU builders that are building kind of things in bulk and wanting to drop them on sites, it's starting to happen, but it's still, I think it's still early to where you could really build prefab communities or prefab houses.
Yeah, I think you're going to see that more as one-off, smaller, ADU, tiny homes kind of thing. I think that's where that style of building is going to, kind of take root first.
Okay, that's great. Thanks, guys.
Yep. All right, let's keep going here, Brian. You good?
Perfect. Okay, so why are we here? Why are we investors on a Tuesday night, September 7th, 2001? or 2021 maybe. Why are we here? We are here because our goal is to accumulate wealth, right? It's to take the savings that we have to multiply that, right? And so part of that goal is probably many of you on the call is financial independence, to the point where you can choose to work or choose not to work, to know that your bills are taken care of and that you have the passive income to do that. So if your goal is to make 20 grand a month, right? And let's just say you can figure out a way to successfully make 8% annualized returns, which is possible to do, then you need about $3 million, right? In order to generate that 20K a month. So the real question is, how quickly do you want to get there? Because, let's say you're at $1 million, well, you got 2 to go, right? Let's say you got 50 grand, you got a significant way to go. So you got to figure out, how do I get to that $3 million figure so that I can start transitioning my assets into 8% cash flowing assets, and then basically game over, financial independence. So, if you started to, and you could skip, I think you might be able to go a couple slides ahead, might be able to do that for me, Dave. But yeah, so if you're investing 50K a year and you're compounding the earnings, right? So if you make 10% annual returns and you're putting 50K in and you're making 10%, it's going to take you 19 years to get to your $3 million. So every year you're putting 50K away, you're making 10% on that, that's starting to compound, right? If you can make 15% returns, then you're going to shorten that timeline down to 16 years, right? And if you can learn how to make 20% returns on that 50 grand that you're still putting away 50 grand every year, but you're making 20% instead of 10%, now you're going to be able to get to that goal in 13 years. So part of what I do personally, and what we encourage you to do is, probably you don't want to put your entire investment portfolio into a development deal, right? But you want to figure out ways to accelerate your earnings so that you can get to that $3 million, so you can get to that financial independent model sooner. So that's one of the reasons we like it and recommend it, is you want to have ability to juice your returns. You want some ability to get outsized returns so that you can kind of increase your capital stack, so that you can then go to more conservative long-term investments. But if you're only making 8% on that 50 grand you're putting away, then I don't have the figure here, but it's going to be probably 21, 22, 23 years to do that. But you can do it much faster if you're earning the higher rates of return, and then also if you start to put away more than 50K a year into your long-term savings plan. So let's just talk some of the benefits of development. Kind of, this is like the high level numbers. So basically we call it the ultimate value add, because value add does make sense. Like, you buy an apartment building and you add value to it. It's a way to juice your returns, right? If you just buy an apartment that doesn't need any work, you're going to pay more top dollar for it, but you're going to make a lower return because there's no real upside to that. So when you take a piece of dirt, or you take a crappy beat up house and you turn it into 4 brand new units, or you turn it into 19 brand new units, then you have created a lot of value for yourself. Basically, if we look at this kind of overview, our goal is to build for like 364 a square foot. Now that's build cost plus land cost. So you got vertical costs, horizontal costs, a lot of different development costs. But basically at the end of the day, if we can basically think about this model of building for 364, but then be able to sell for 540 a square foot, right? If it's worth 540 a square foot at the end, then that delta between those two numbers, that's our profit, right? So let's just look at our new fund. Dave and I are working on a new fund right now. And so the goal is, when we build these, we want to build to a 6 cap. So basically that's acquiring at a 6 cap. Right. And so right now, if you go to in LA and you go try to buy or acquire brand new construction, and you try to buy it for a 6 cap, you're going to get laughed at. Right. Because just so you know, for people that aren't familiar with cap rate, but basically cap rate is like, what are people willing to pay for this income stream? Right. So let's look at the number $160,000 a year. So if you want $160,000 a year, if the market is saying, hey, we're willing to pay a 6 cap for that income stream, then it's going to cost you $2.7 million to buy 160K of income. But if the market is saying, oh, we want a 4 cap for that, right? Then the market's going to say, you need to give me $4 million to get that same $160,000, right? So the way we're looking at it is, rather than, I mean, we could go in the marketplace and we would buy the 4 cap, which again, it's sort of like golf, your low score wins, right? Your 4 cap is much more expensive, right? It's where you want to sell, but you want to buy at a higher cap rate, right? You want to acquire at the 6 cap and be able to turn around and sell it at a 4 cap, because that's an exponential difference, and that allows you to create a lot of value. If you just go buy 4 caps, it's hard to see the upside potential in that, but we want to build at the higher cap rate, because that's a lot of value for us, and then sell at the lower cap rate and capture that value. And we see it as the best way to get a discount in LA. It's basically, it's like we're into the build to rent, right? And then the build to sell, both those models. But basically, it's our way to acquire assets at a discount. And you do that by basically building them. When you have brand new construction, it's a better asset to own. If you buy a building that's 30 years old, you could deal with lots of leaky pipes. You could deal with sewer issues. You could deal with an obsolete floor plan, less desirable floor plan, right? When it's brand new, everyone wants to live there. It's super nice. You're going to have lower maintenance costs because nothing's breaking down, because everything's brand new. Your air conditioners are all brand new. You have higher efficiency. It's just easier to run the building. If you are paying for utilities, they're going to be lower because you have brand new air conditioning. You have brand new, hot water heaters, versus an old building, maybe very inefficient, very outdated. And if you are paying those expenses, that's going to be very expensive to you as an owner. So owning efficient systems is another way to help maximize your income. It's also a good way, when you go to lease these up, right? It's like, well, who wants to live in a place that's like 30 or 40 years old with 8-foot ceilings, when you could go to a brand new thing that has 9 or 10-foot ceilings, open floor plans, brand new, backsplashes, and beautiful looking, Instagram worthy housing. That's where people want to live, and people will pay a premium for that. So it's a superior asset to own from either a build to rent or a build to sell model.
And Bryan, I'd even argue that, because you can charge a premium rent, tenants that pay premium rents in the long term tend to be better tenants. So you probably have less in maintenance, less in turnover, just because, people that have those kinds of jobs to afford a premium rent generally take better care of them as well. And they tend to be more reliable, tenants.
Absolutely. I agree with you. So yeah, to Dave's point, higher rents come from more higher qualified tenants. If somebody can afford $4,000 a month versus somebody else can afford $2,000 a month, they probably have a better job. They're probably a little more stable. They have a higher FICO score. All kinds of good stuff comes from renting a higher desirable place, because you also have more people competing for that. If everybody wants to live there, you're going to have a greater selection of tenants than if you're just like hoping that someone with a 450 FICO score and they've been to jail 6 times, and you're just hoping they'll rent there and keep paying, right? It's good to have just the ability to be selective in your tenants and great demand for your property. So, and part of that is design. We like designing. We like building places that have rooftop decks. It's a great place to hang out in LA, go up at night, the cool air, just expands your footprint. It's actually not any more square footage or livable square footage, but it makes your property way more desirable if you can go up to the rooftop deck and hang out, relax after work, have your friends over there, can see the Hollywood sign or downtown LA from the rooftop deck. It just makes for a much higher demand building. And also, one of the reasons we like housing is it is fulfilling a universal need. Everybody needs housing. Somebody asked a question about what do we think about office? What do we think about retail? Office right now is pretty uncertain. The world has really changed. Will work from home stay the trend? Possibly. I have a friend that just actually also moved down here to Dana Point. He used to go into Santa Monica every day. Now he has to go in 1 day a week. So now his choice of where he gets to live, much different. They actually own the building, but if they were renting the building, they may not rent the building any longer. I think office is under radical change right now. Change creates opportunity, but you also have to be super careful because the world is really changing right now. We don't know what the long-term demand is, even in downtown LA, for office there. I wouldn't build office right now, not in LA, I wouldn't. Industrial, I think there's still opportunity, but, and somebody else asked about retail. I think with everything, it's hard to say like, yeah, retail's bad, retail's good. There's opportunity in retail, but only through super sophisticated sponsors and people that really understand that market super well. Again, as a real estate guy, it's good to think a little contrarian, right? If everybody is doing the same thing, then profits are going to get really squished, right? If everybody's looking for mobile home parks now, we've seen it go from like 9 and 10 caps when I first started investing in that asset class to now people are paying 4 caps for that same mobile home park, right? Which means they're paying more and more for the same income stream, right? You want to be the guy who's paying less and less for that income stream, not the guy paying more and more. So again, it's part of being different, and it's part of why we like this development space. Is not everyone is doing it. It is complicated. It is complex. It does take some skill. It's not for everybody. There's not as much competition. So we like the niche of getting in there and doing things that not everyone is doing. That creates opportunity, that creates profit. If it's simple, one of the downsides of self-storage is somebody else can build a self-storage unit very inexpensively right next to yours and undercut your rent. That's one of the downsides of that business. It's a great business, but you have to watch out for competition. Where, when we're building our project in North Hollywood, it's going to take anybody else who wants to build 37 units a long, long time to build those and try to compete with us. And even if they do build 37 or 100 or 200, I mean, in terms of supply, like 200 extra units in the valley, Dave, that's probably not going to move the needle, right?
Not a lot. We could sell them pretty quickly.
Okay, so let's talk about some of the risks, because again, some people just write it off and they're like, oh, I don't want to do it, it's too risky. So again, we want to think, how do we mitigate risk? How do we minimize risk? And how do we manage that risk? So yes, development is more complex and it is difficult to execute on. Again, I touched on some of the others. When you don't have entitlements, you're dealing with a whole nother level of complexity. You are dealing with longer time frames, less predictability. If you start a project in a super hot market, by the time you finish, it may not be. So the market, you have some risk, like where's the market going to be in 2 years or 3 years? It could be much better and that could benefit you. It could be worse. It could kind of start getting cold. Interest rates could be much different in a while. So there are definitely risk factors to that. And you have to kind of model that in. You can't model in assumptions and saying, oh yeah, these people are going to be able to get 2% financing in 3.5 years from now. It's like, we have no idea what the world's going to look like then. And so you better model in something that's a little more closer to the actual historical interest rate, right? And you better be able to withstand that. If it happens that rates are still low, great, but you have to basically plan for the world to be a little closer to normal, or maybe even a little bit not as favorable as things are right now in the future. And you want to make sure your model can withstand that kind of change, because the world is changing and things do change. The financing is more complex as well. When you start, you basically have a piece of dirt, right? And so a lender looking at a piece of dirt and they're going to basically foreclose and take over your piece of dirt, it's not super valuable and compelling to them, right? So your financing is probably going to be a little more complex. You may pay a little bit more for your financing. So financing these projects is also an art in itself. Again, super sophisticated developers who have great experience, great track record, they're going to have relationships with banks. They can get low interest, long-term construction. They may be able to do a construction to perm financing, meaning they'll finance the construction. And once it's done, it converts to permanent financing at a really nice low interest rate as well. You want to look for that as a possibility, and you want to basically ways to minimize risk. And then as you go through a development project, you are basically taking draws against your construction draw, right? So as you build the framing, you pay for the framing. So basically your cost starts going up and up, which means your carrying cost of that debt also is going up. So the more time that goes on, the more expensive the project gets. You plan for that, but then when you hit unexpected delays, that's where that can start to eat into your profit margins.
Bryan, can I chime in with the question here on the financing end of this? I remember speaking to somebody on construction loans. They correct me if I'm wrong, but do they tend to finance into it interest? I guess what they call it. I think they call like an interest reserve fund or something to that
Right.
nature, because you know obviously the project isn't generating any income until after it's finished.
Sure.
So how does that kind of work there?
I would say it's negotiable. What you're referring to, I believe, is like prepaid interest, where basically your interest payments are kind of built into the loan. So let's just say you're borrowing $1 million, but instead of borrowing $1 million, they're going to lend you 1.2, right? But they're going to basically keep their 0.2, their $200,000 for the interest payments. They're going to keep that and kind of pay themselves in advance. The benefit to you is you don't have to service that debt along the way. But the bad news is you've kind of already paid your interest up front and you owe that money. So it can, again, is it a bad thing? No. Is it a good thing? It can be. Again, it has to be managed well. You have to make progress during that time to make sure that your project's going to be in a good position when it's time to pay the piper. But there are ways to manage that where you kind of prepay the interest or it's built into the loan. Again, you have to be careful because it's easy to get complacent when basically the pressures aren't there. You think, oh, everything's fine. I got my interest reserve and it's going to cover me for like 9 months. Well, you better be prepared for month 10, right? And not relaxing along the way. And then a month 8.5, you decide to get really serious about what you're doing.
Okay, that's very interesting. Thank you.
Absolutely.
I'm gonna move on to the next section, which is basically we call it development demystified. But I did want to get Mary asked a question a while back asking about how investor returns are typically structured in a development deal, and your question was with a pref rate and a split, and the answer is yes. That's generally what you're looking at. There is some kind of pref. I'd say what's typical in the space is anywhere from like 6 to an 8 pref. You might find something that has something a little lower. You might find something that has a pref that's a little higher, but generally that seems to be the range. And then the split's going to be anywhere from like a 50-50 split to like a 70-30 split. So something that has a lower pref might have a higher split, right? So if you find a deal that's like a 6 pref, you might have a 50-50 split with the developer, versus if you find a deal that's an 8 pref, you might have like a 70-30 split, with or 60-40 split with a developer. So that tends to be the where the how these deals are structured. Obviously, like Bryan mentioned, you're not getting any income off of this. So when you're investing in development, you're not getting cash flow immediately. Now, you might be investing in a project that's going to deliver cash flow eventually. So really the cash flow that you're earning is your pref, and that's going to continue to accumulate, while construction is happening. And then like in some of the deals that Bryan and I get involved with, and he mentioned that you can, kind of take out construction financing, which is temporary or temp, financing. And when the project is completed and leased up, if you decide not to sell it and to hold it, you can put long-term permanent financing on that. Well, you've created so much value with the spread of how much you spent to acquire it and how much you spent, how much you earned in selling it, that if you decided to refinance it, usually what you can do is you can do a cash out refi. So besides, paying off whatever loans you have that for construction and acquisition, you can also usually take out some additional capital. And a lot of times what we'll do is we'll kind of use that money to start paying off some of the pref that our investors were accumulating along the way. And then ultimately, once the project gets stabilized and starts generating cash flow, now you're just in a typical buy and hold kind of development. So hopefully that gives you a little insight on how some of these deals are structured. Oh, and the last thing you asked about is, are investor returns diluted as you move the project through different development phases? That really depends on if you get into a land development deal, right? Because a lot of times when that happens, you don't have a construction loan, it's just an acquisition loan. And usually you'll use equity to go through the entitlement phase. And then once they get the entitlement, then you'll bring in new capital for the construction phase. And then, as far as you get diluted, you shouldn't. If the deal is going well, you should get rewarded for being in the deal early. But there have been times where investors have gotten diluted, especially if there was an extended timeline on getting entitlements done. But usually you should be rewarded if you're in the deal earlier because you did take more risk, and there's more risk. Not that building isn't risky, don't get me wrong, but there's more risk in the entitlement phase than there is in the construction phase. So you generally, the earlier you are in on the deal, the higher your returns should be. So I hope that answers that question. All right, so let's go ahead and get into this next section. It's called Development Demystified. And what I'm going to do is we are going to talk about the different phases that are involved in a typical development deal. So, there are 5 main phases. Number 1 is the acquisition phase. Number 2 is entitlement. Number 3 is getting the site prepped and ready for construction. Number 4 is obviously the construction. And then last but not least is stabilization. So typically, when you're acquiring property, I'd say this, and we put some, some approximate timelines here, just to give you an idea. I'd say the first 0 to 6 months is the acquisition phase, right? And the major steps here are, if you're buying raw land, a great way, especially in Southern California, a great way to make money is to assemble different lots or conjoining lots together. So this particular project, this is actually the 27 unit small lot subdivision that we were talking about. This was actually 5 separate lots that were assembled and then basically, rezoned into 27, 0 lot line or small lot projects here. When you start to assemble different parcels together, it gives you more opportunity. And if you think about it, I'd say the biggest way to think about that is we're all familiar with the concept of setback, right? So if I have, let's just say my setback in LA is 5 feet, which is usually what it is. And I've got 5 separate parcels. Well, every parcel there has a lot line that has a 5-foot setback on each side. So it's 10 feet of space that is undevelopable. But if I take all 5 of those lots and combine them into one lot, obviously I eliminate a lot of setback on the, in the internal parts of where the, where the lots are. So that's a big thing that developers love to do is assemble properties. Sometimes that can take way longer than 6 months. But ideally, if you're pulling a couple of lots together, that's a great way to create value. Bryan already mentioned the term RTI projects, which is ready to issue. If you're looking to buy an RTI project, well, your timeline will be even quicker, right? Because at that point, the lots have already been assembled. They've already gone through some layer of the approval process. It's ready to issue. And the reason why the permits haven't been pulled yet is, whenever the city is going to issue permits, they want to issue the permits to whoever is going to actually be building the project. And if I'm just assembling and going through the entitlement process, and then I'm going to sell it to another entity that's going to build it, well, I'm going to sell it to them. and then let them go through and pull the actual permits in their name, you know, because it needs to be under their contractor's license and there's all kinds of, you know, specific things that have to happen when you're pulling your projects. You know, the last thing that you need to be concerned with is zoning. And, you know, when you're really getting into some complex stuff is when you're buying a property and then trying to change the zoning into something else, which then usually means you're going into, you know, some kind of community project, and generally things like that that require zoning changes, you know, unless it's a single family house and, you know, someone's just looking to, you know, buy a piece of parcel, a piece of land that may be entitled for commercial and they want to build, you know, a residential property into it. But if you're looking to do a big project and changing zoning from, you know, something like industrial or commercial to residential, then, you know, that's usually stuff for, you know, institutional grade investors, and we don't really get involved in that. So some of your key partners in the acquisition phase, obviously you've got brokers. A lot of developers have their own internal sales teams, right? So they'll be constantly calling, looking for, you know, land to buy. Capital partners are people, you know, when you're in the acquisition phase, you know, some investors like to put together the acquisition part with just equity and no debt, and then they'll save the debt for the construction phase of it. So, you know, that's you know, having capital partners is a key partner in this phase. If you're buying anywhere in California, chances are you're going to have some kind of environmental issue. So understanding the underlying, you know, previous usage of the land, and if there are some, you know, environmental issues, having someone that can help you navigate through that's a very important person. Surveyors are important, you know, understanding exactly where the lot lines are and knowing where all your, you know, not just the endpoint, but you also, you know, you're building three-dimensionally. So understanding where your high points are, where your low points are, those are super important when you're looking at land. Having a land use consultant is important, right? So what can you build on the land? Can you build a 10-unit apartment building or a 12-unit small lot subdivision? You know, having someone that can kind of look at the code and help you extrapolate what's possible, especially when you start assembling parcels together. That's a really important person to have on your team. Having a geologist on your team, understanding that, you know, the actual composition of the soil and knowing what, you know, what exists there. Is there bedrock? You know, are you going to have to build it on pillars? If you're doing anything on a hillside, there's all kinds of complexities in building on a hillside. And then lastly, a civil engineer, right? So that's someone that's going to help you kind of lay the property out, you know, when you're getting through your planning process, you know, understanding, you know, where do curbs and gutters and how do you tie into the city, you know, the sewer system, the water system, all those types of things are things that your civil engineer is going to help you to navigate. The next phase is the entitlement phase, right? This is where you're going through planning. You know, this timeline can take anywhere from 6 to 24 months. You know, one of the terms that is happening with entitlement is a term called by right. And what that means is that I am going to buy a piece of property and then by right, based on what the code says, I am going to build exactly what is, you know, what's allowed by the plans by the city. And generally, when you're going through entitlement and doing a project that's by right, it's going to go a lot faster. Where you start getting into more complexities is when you do start doing some of these bigger projects, and then all of a sudden you start looking for bonus density and you're looking to get additional, you know, maybe sometimes you can do a low cost, a low income unit and you can get additional units because of that. That's where timelines really start to get extended. That's where, you know, the community can get involved. You know, you can have neighborhood reviews and things of that nature. So something that's by right is going to take closer to 6 months. Something that's going to have, you know, bonus density and all these different, you know, complexities to it can take, you know, 2 years or more. You know, we've seen some projects that have taken, you know, anywhere from 3 to 4 years just to get their, you know, to get their plans approved. The major steps here are your plan development, right? So it's physically working with your experts, trying to figure out what you want to build, your land use expert digging into the code, your civil engineer, trying to plot out where on the lot it's going to go. The engineering on this is huge. You've got civil and you've got structural, right? So if you're building, anything over 3 stories is considered a commercial grade property. So 4 stories and above. If you're going to go subterranean, building a subterranean parking lot, that adds complexity, and you need, more and more engineering to get that done. Depending on how high profile your project is, you could have to go through a neighborhood approval process. And that's where all the neighbors get to stand up and tell you what a horrible person you are for putting new construction in their neighborhood. And you have to let them know that, hey, listen, we're taking down old stock and we're putting in something brand new, and it's going to help all of your, all of your home values. And generally it's a negotiation, right? It might be a negotiation on colors. It might be a negotiation on how many units you can put in. But if you do get a group of neighbors that are, motivated against your project, it makes things very, very complex. And then last thing, you need are city approvals, right? So getting all your plans done, submitted to the city. If there's been one thing that COVID has created the most complication on, it has been dealing with the cities and the municipalities that we deal with. That was already a complicated process. Now you're dealing with people that used to be working behind a counter. Now they're all working from home. You're doing everything by email. You can't go, things that used to be over the counter that you get very, very quickly, now have become, a lot more complicated. So, getting approvals on projects right now, it was already complicated. Getting it done through COVID, we think it's gonna, it's gonna create a backlog of new construction projects for a few more years until the city, lets their people get back into the office. Some of your key partners in this phase, you're definitely looking at your architects, designers, your civil structural MEP, which stands for your mechanical. MEP is what? Mechanical, electrical, and plumbing, right? So it's all of your engineers on how the water flows, how the electricity flows through the building, having them design their systems in your planning parcel. Your engineers are key partners in this phase. Your consultants, which are people that you can actually hire to navigate through the city. There's a lot of old people, retired city employees that now act as consultants in that same municipality. They've got relationships and they can kind of help steer your project and expedite it. Sometimes consultants are called, well, expediters, are people that will help to get your project approved faster, get your project on the top of the stack versus the bottom of the stack when you go into the city. So again, entitlement, this phase is one that we consider the riskiest, just because there's a lot of unknowns. But once you do get your entitlements done, right, now you get your plans issued. Now all of a sudden you get into site prep. And this is, it can take anywhere from 2 to 6 months, depending on what was on the land before you started construction. Some of the major steps here, number one is demolition, right? So knocking down whatever used to be on the land. Even that now, depending on the city, depending on the property, can be complex. If the old home had asbestos, you can't just knock it down. You got to remediate it. Certain cities want you to recycle, it's recycling wood and tile and glass, and you can't just knock it down. You have to kind of take it down piece by piece. But demo is the first thing that you do. Next thing would be any environmental mitigation. We're involved in a project right now where a neighboring property had, what was it, Bryan, a dry cleaner or a gas station?
Yeah, dry cleaner, and the chemical evidently is spilled into the ground, even though it wasn't our project or our property, because it kind of leaked into the water base. The city wants to make sure that no vapors will come back up into our apartment, basically building that we're building. So we have to install some vapor barriers.
So picture this picture on the right here, picture a huge piece of plastic on top of it. And then having vents that would go up on top of the structure. So we're actually having to design a vapor barrier before we can start building to prevent any of that from leaking or leaching into the building itself. So hopefully we don't have a lot of that, but it's just part of development. It's something you have to deal with. There's a lot of survey stalking. So this is what your surveyor is going to go in, where are all your foundations going to be? Where's all your plumbing going to be? Making sure all of that is marked out before you start digging. And then you have all your earthwork and your grading, right? So compacting the soil, making sure that it's ready for, whatever structure is going to be on top of it, keeping it flat, grading for water. These are all key pieces to this site prep. Obviously here, your key partners are your general contractor, your surveyor, and then of course your subs, right? So electrical, plumbing, those things go in the ground before concrete does, right? Because they usually are hooked up underground and then eventually tied into the city services. So here's some of your key partners for this site prep phase.
Sure. And actually, George is asking a question that's pretty interesting. Can you discuss using options on land acquisitions as you work on entitlements? I think it's a great idea. Again, if you're not familiar with that, basically it's like Dave owns a piece of property. I might want a development, but I'm not sure what I can build on it. So I go, hey, Dave, I'm going to give you $5,000 as an option to buy this. That gives me time to explore what my options are. And I've only risked $5,000 versus I buy it from him for $5 million and then I later find out I can't do what I want to do. It's a great idea. I think the other one that I'd encourage you to keep looking at is joint ventures. So you go to that owner and rather than even paying him the $50,000 option fee or whatever he's going to demand, you say, hey, let me be your partner. And then together you could go explore that. If he comes along for the ride, maybe he can donate the land as his basically contribution to the project. And he would be a substantial investor in the project. But instead of buying that piece of property for $5 million, carrying the debt on that, having that be a burden to the project, now you have a partner that basically brought your $5 million piece of dirt, which maybe he paid $1 million for a long time ago. So he doesn't mind just bringing it because eventually you're going to take his $5 million piece of dirt and turn it into a largely profitable project. So I think there's a lot of different ways to try to mitigate risk, but it's a great idea to think about that either from an option or a joint venture or some other way rather than, hey, I'm going to stoke a big check and I hope it works out, which we would discourage you from doing.
Bryan, hey, Prasad just asked an interesting question, kind of along the lines there of this whole option creative financing method. He says, can we get a long close on a property and do the permitting during the pre-closing period? If so, how do we protect our permits, our costs in the project in case seller fails to sell the property? I seem to, I know another developer builder who he was doing option agreements while maneuvering the whole entitlement process, I think is what it was. Is that pretty common?
It's a great way to minimize risk, right? As opposed to you buy it and you realize you can't build on it what you hope to build on it. An option is a great way to minimize your financial outlay. To the question talked about like, hey, can we do a super long escrow and get our permits during this time? It's possible. Again, there's some risk there. Like they're already pointing out the risk of what if you don't close and you just spent like $100,000 on getting all your permits, your plans, because in order to get permits, you've had to hire an architect to do all your plans and you've had to do a lot of other legwork. So you have to be really careful before you start laying out big chunks of money and knowing for certain that you're going to be able to close or that you're going to actually be able to build what you hope to build on. Or some of that is risk capital. You just have to be careful, especially I would talk to the investors on the table. If they're getting involved with this project and they're putting up that $100,000 for these kind of pre-entitlement costs of architects and those kind of things, again, you're playing a very risky game with that. Especially if you don't have a super experienced or, a super experienced partner that's been through this, many, many times, that has an incredible team that could almost guarantee you with certainty they can do what they hope to do. Again, anytime you're an investor with these projects, you have to really think carefully about who am I partnering with? How many times have they been to the dance? What has been the results when they did go to the dance? You know, it's not something you want to find somebody that's done it like 1 or 2 or 3 or 4 times. Again, these are super complex, super expensive. You know, I mean, if you're talking a big project, you could spend a couple $1 million before you even know that you have the permits to build it, right? Or you could be paying a lot of money in option fees as you especially get into commercial construction. There are big projects, big money, big risk. So again, you want to find great partners to help to minimize that and mitigate those risks.
Okay, that's great.
So looking at the construction phase, you know, once you've got your permits, your land is prepped, this is where, and a lot of times we call that horizontal cost of construction, right? So that's building everything flat. This is the exciting part. This is the vertical part. This is where things start going up in the air, sticks in the ground. Everyone gets super excited here, you know, because we've all had that framing thing where you drive by a property and then there's nothing there, and you drive by a week later and there's all this framing, and then you drive by like another week after that and the whole damn thing is framed. This part goes fast. And some of them, you know, in the construction phase, it's anywhere from 6 to 24 months, again, depending on the complexity. If you're building a single or double story house, you can probably build that maybe closer 6 to 9 months. If you're building something a little more complex, you know, like this, you know, the project that we're working on, you know, you're looking at 2 to 3 years to get everything completed. Some of the major steps in the construction is, number one, you got to get the footings and your foundations right? So pouring all the cement that you're putting the wood on. Number two is the site utilities, right? So where does water, power, gas, internet, you know, sewer, all of those things have to come and into where the homes are going to be. Then you've got to frame it up. And you know, mostly framing is done with wood, but even here you can see we've got some metal here. We've got some, you know, some shear walls. So it's a combination of both metal and wood when you're framing it up. The next step is, once you get it all framed, you have to add the roofing and the windows, right? So basically you've got to seal it so water doesn't get inside of it. And then, you know, that's really where you have your weatherproofing, like, so your roofing, you know, wrapping it on the side. This is a major phase through here, is adding all your HVAC, like all the vents that go in the walls have to be in this phase. And then once you kind of have the exteriors done, you know, then you move into the interiors, right? So this is where you get your, you know, your mechanicals, your electrical, your plumbing. It's all the roughs. So the first thing they do is they rough in where all the plumbing, where all the outlets are going to go. And that's a big moment when you can clear that inspection, because once all that's been cleared, then you can start insulating and drywalling the actual home. Once you get all your drywall in, usually floors and ceilings get installed. That you can then paint it. Then you can start adding your doors. And then the last thing you do is you start adding your fixtures, right? So that's where your cabinets and your sinks and your countertops, all your tile work, all that type of stuff goes in kind of on the last phase there. You've also may have heard of these two terms, your on-site work and your off-site work. So your on-site work is everything that's on like your property, right? So it's your lawn, your driveway, your grading, any paving, any of your landscaping, versus your off-site work is all the work that is, kind of connected to the city. So it's curbs and gutters, alleys and roads, adding street lights, any city utilities, all of that type of stuff, which, you know, is a combination of you having to hire subs that are qualified by the city versus subs that understand what the city requirements are and have good relationships with the city to get that work approved. So, you know, looking at who some of your key partners here, well, obviously there's a lot of them, right? So you have all your subs, you know, plumbers, electricians, framing, your HVAC subcontractor, you've got roofers. If you're adding an elevator, that's like almost like a mafia. There's only a couple of these elevator contractors around the country that do elevators. We highly recommend you stay away from elevators and subterranean parking. It's very, very complicated. You've got landscape architects, people that do tile and stone, all your metal work, so any type of flashing, windows, anything, like gutters and things like that. You've got people that specialize in flooring, painters, fire alarm and sprinklers, all that type of stuff. You have all these subs that you have to have relationships with. And you're still dealing with engineers, both through civil and structural, because you're still, continuing to get things approved along the way. And then you're dealing with the city at this point. This is really where you start having, both your city and your deputy inspectors coming out, charting your progress, signing off on your job card along the way that, these certain things have been done. We also get involved with using both, utility and land consultants, right? So helping you, besides dealing with the city, we're dealing with DWP or SoCal Gas or whoever your utility companies are that deliver to that. They have their own approval process that you also have to navigate. And then you finally get to a project is completed, and then you get into stabilization mode. And that might mean, stabilization could be quick, right? If you're looking to sell it right away. So this is basically a construct to sell. You're looking at a month or two. If you're looking for something that is, you're going to hold on to it, then you've got stabilization as far as leasing it up. So some of the major steps here are getting your final inspections done, getting the city to sign off on everything. There's two phases of getting your final sign off. Number one is getting your job card signed off on. So that's where the inspector then goes through and checks everything off that has been done. And then once you get your job card signed off, then you can apply for your certificate of occupancy. And that's usually, what you need to actually let people start to live in the project. You have your sale or lease up. And then of course, we always like the BRRRR, right? Build, rent, refi, repeat. This is what we love to do. We love to build it and hold it and get some cash flow for a few years before we sell it. All right. And here we got some of your key partners here, your city inspectors, your engineers, consultants and expediters. Once you do get into lease up, having a property manager that understands that market. And then of course, putting insurance on the project long-term.
Perfect. Hey, let's move into the lessons learned. We're running a little short on time, so I'm going to crank through this pretty quick. But we have learned a lot of lessons. As we mentioned earlier, Dave and I put this resource together called Lessons from 50 Deals. And it's really about, different things that we've learned, both positive and negative, some of the ups, some of the downs. And it's a great resource. Just sign up. It's free. Just go to our website, capitalstackinvestments.com, fill out the form. Last question is, do you want to receive our 50 lessons? Just indicate yes, and we'll be happy to send that to you. But I'll give you a few overviews, but there's a lot of detail in those written lessons. It's a great resource. So one of those, lesson number one here, is to be fast, not cheap. One of the most expensive things when you're dealing with construction is things take time, right? And as they take time, it costs money. You're borrowing, in some cases, large sums of money. Even if you're borrowing small sums of money, when you're borrowing money, the clock is ticking. And the longer that clock ticks, the less profit you're going to make. So sometimes you have to figure out, like, let's just say, okay, we can save 10 grand by using this vendor, but he's going to take 3 weeks, right? But if your whole project is costing you 50 grand a month, to wait those 3 weeks for the guy, or extra 2 weeks to get the cheaper guy, you might actually spend more money overall, right? If one guy can get it done in a week, you pay him 10 grand more, but he saves you 30 grand in holding costs. Well, you're 20 ahead, right? So you want to think about moving quickly. You want to think about professionals that will show up when they are supposed to show up, are reachable when you need to reach them. It's not a world you want to live in with undependable partners. You want highly dependable partners because time is super expensive. It's better to save a day than a dollar, because the day might cost you 2 grand in holding costs, where a dollar is just a dollar. So build your capital stack wisely. If you're getting involved with this, you can decide from the investor standpoint. You may want to be pure equity. That's going to be probably the greatest amount of risk, the greatest amount of potential upside. You may want to be, there may be a common or a preferred equity portion. A preferred equity is almost a little bit like a bond. Sometimes it's like, hey, we'll pay 8% to preferred equity. Some people like that position. It can be paid out monthly. It can be very dependable. So again, it depends. Like if you're that guy with the $3 million and you get a chance to make your 8% monthly, maybe that's what you want to do. If you're building your capital stack and you're trying to get to that big net worth, then you may want to be on the equity side, or you may want to do a little bit of both. But there's different ways that these projects are financed. Sometimes private money. That's where Dave and I help kind of raise private equity for these projects. And some of these projects ends up with institutional debt. As you get to see these bigger projects or these $100 million projects, those are almost always like financed by some pension fund or some big Wall Street money. It's just too complex to raise private equity for those big scale projects. And then fixed bid contracts. This is something else you can discover as you're learning in this space, but it's really great if you have a fixed bid contract from your contractor, from your construction team. And basically they're going to bid out that project and they're going to say, we're going to build this project for you for $3 million or for $7 million, right? And it's fixed. If the cost of lumber goes up, if steel goes up, if things get delayed, well, they still have to build it for that set price. It's a way to mitigate risk. If you don't have this, you don't know what your construction costs are. You don't know, there's, again, you're trying to minimize your variables. You're trying to minimize uncertainty. So if you can get a fixed bid contract, it's best. And then we like situations where there are penalties and incentives for your partners to perform. One of the things we really like is to align interest, to make sure that like when the contractor wins, we win as a project. So you can set it up where if the contractor can save 10 grand, maybe he can pocket 2,500 and the project's pocket 7,500. It's a win for him. It's a win for the project. You want aligned interest. You want when the developer or the main guy, when he wins, the investors win. You don't want a situation where maybe the construction team is going to win and the investors are going to pay for that, right? You want to try to create situations that you have very aligned interest, that you all win together, or you all are taking the lumps together, because you don't want to be the only person taking the lumps. You want everybody to be paddling the canoe in the same direction at all times. And then your systems matter. Again, organization, it's a highly, it's a game of organization. It's a game of shaving days off. If you're super sophisticated, you figure it out like, this guy's leaving on Wednesday, so the next guy's lined up for Thursday. If not, you can lose a week of time, 2 weeks of time. So scheduling, systems, organization is super important in this game. And basically your profit is a function of your efficiency. If you can build fast and efficient, you're going to build more profitably. If you're disorganized, you're gonna pay for it, and the cost is high. And then choose your projects wisely. There is a big difference between commercial and residential projects. Residential is typically, and even in residential, we'll talk about it, it's at the bottom of the slide, type 1 versus type 5. The simplest construction is going to go up the fastest, right? I just say that, it sounds quite obvious, but sometimes on paper, these gorgeous buildings like the one that's on the slide, right? It looks, oh, we're going to build this, it's going to be really nice, but that's a highly complex building to build versus, a duplex. And the duplex is going to go up a lot faster. It's going to be simpler. It's going to be easier to inspect. The inspections are going to be easier. The level of oversight from the inspector is going to be much simpler if you're building an ADU or you're building a couple units all out of wood. Then once you get into this like multi-story, 6-story, whatever it is, building, you have to start using all kinds of complex materials. People are really looking out for safety. We don't want to have situations with buildings falling down. So just the level of inspections, fire sprinklers, all that, it's super complex. And as a result, complexity is going to add time, and it may not be as profitable as it looks like on paper. And then choose your partners more wisely. I can't emphasize this enough, but they talk about like your partners and who you're investing with. It's every bit as complicated as getting into a marriage, because you're really getting into a very close and intimate partnership, even if you're not interfacing with them. But they have your capital, they have your future, they have your freedom at their disposal. And is it going to be somebody that your friend recommended? What kind of track record do they have? What's their historical performance? And then can you verify that historical performance? I've had situations where people sent me lists of projects they did, but well, it was actually somebody they worked for did, but they didn't actually do it, right? So the longer you do this game, then you realize like, oh, it's a trust, but it's very much of a trust and verify, right? You have to figure out like, did they actually do those projects? I had another partner. It was like this beautiful flip in Westlake Village, and it was featured in the magazine. It was all slick and it was so beautiful. And it talked about like this amazing job, and he looks like a hero. Well, I was an investor in that project, and unfortunately he didn't make any money on that project, but it still looked really good because it was so gorgeous and beautiful. But just because somebody's in a magazine promoting what they do doesn't mean they do it profitably or do it super well. So again, you have to verify all the details, and who you're betting on, who you're partnering with is the most critical part of the whole game there. And that goes apart no matter what you're involved with, what kind of investing you're involved with. If you're involved with, you want to buy into a self-storage deal, or you're going to do a flip with somebody, all these things are so important to do as much research and due diligence upfront as possible. And then the KISS principle: simple projects are easier to execute. Sometimes developers, they can be kind of a little bit like a risk-taking personality, take the hill kind of personality. Hey, we're going to invade and we're going to take over and it's all going to be beautiful. But you have to kind of temper that with, okay, these things are complex. What if something goes wrong? What if things don't go according to plan? What's the contingencies? How many times have you charged up the hill and won before? People can say like, oh, we've done this 1,000 times. Well, okay, let me see the addresses of all 1,000 projects. You have to, again, trust, but very much verify.
All right, last few things, and we'll go through these slides super quick. So does development make sense for you? All right, well, first thing you have to understand is what's your investment plan? Everything that starts with knowing yourself, like what are your goals? What are your plans? Make sure that you have a firm understanding of what you're trying to accomplish before you start picking investments. And then know, how are you growing your capital stack, right? Bryan talked a bit earlier about using some of these higher risk, higher reward projects when you need to make up some ground or accelerate, the assets that you're growing. So that's important to know, having a plan. And then, know that I think one of the big things we've learned is wealth is about acquiring assets, right? And why we like development is because we can acquire those assets at a discount. There's ways you can develop. You can self-perform, right? Find a piece of land, hire a contractor, especially if you're going to do like a single family house, maybe an ADU. An ADU is a great way to get started. Something that's smaller, a way less complicated approval process. I think that's a great way to kind of get your feet wet in development. You can lend money to a developer or contractor, right? So that's another way to do it. Find someone that you trust, that you think's doing good work. Of course, do all the due diligence that Bryan talked about, but that's another way you can get involved. Sometimes if you have land, you can JV with a developer or contractor, right? So if you've got land and want to partner with someone where they'll come in and supply all the necessary everything that they need to build, you can supply the land. That's a great way to do it. And then, lastly, you can look at investing into a syndication, right? So becoming either an equity or a debt investor into a syndication where you're getting pulled up and putting in a smaller chunk of capital. It'll give you some exposure to development, but maybe not necessarily the actual, experience in doing development. So with that, we will leave you with, once again, first of all, thank you, Omar, and everyone for hanging out and listening. We hope this was informative. We tried to make it a little more about the process of development, just to give you an idea if you're ever involved in something, so some of the terms might make more sense. If you're interested in, our lessons from 50 deals, go to capitalstackinvestments.com. I actually posted a hyperlink in the chat that you can actually go directly to where the form is to sign up. I do have a monthly investor email. So if you're interested in that, we send out more fix and flip per se than development opportunities. Send me an email, david@coregroup.com. And then for either of us, if you're looking to talk real estate, we have our calendar links here. Feel free to, click on those links and book a time on our calendars. We'd love to meet you. And with that, Omar, thank you so much for having us.
All right, David, Bryan, well, thank you so much for all that awesome information. I'm sure all you out there got a lot of new insights into the development process, definitely the complexity that's involved in it, the importance of having a good partner, good team, and good people working on your projects there. Wow, very fascinating, very enlightening presentation. And I do want to remind everybody also that if this whole presentation is recorded, so if you want to get the recording of this, it's going to be a private link. It's going to be uploaded to our YouTube channel. And to get that private link, you need to put your email in the chat box so that our assistant Zaldi can send you the link after it's edited and uploaded there. So I know I'll definitely be watching this again. And, make sure you guys go to their website, capitalstackinvestments.com, get the document there. Lessons learned from 50 deals. I'm sure you're going to get a lot out of that. Awesome. David, Bryan, thank you once again. And with that, everybody make sure you come on out to our club next month as well. What is that? I believe it's going to be October, looks like October the 5th. And yeah, great. Thank you very much. Guys, do us a favor, leave us some nice comments on our meetup site. And yeah, send some thank yous in the chat box to David and Bryan, man. They did a really excellent job here. Thank you so much.